Now, another thing that's going on and getting a lot of attention here in Washington is the Fed has been pretty aggressively buying bonds, $85 billion a month. And some people think that we're building a bond bubble, that interest rates are so low that they can only go one direction up, and that a whole lot of people who have money in bonds don't understand the risk they're taking. You must have a lot of investors who are in bond funds. What do you tell them?
Well, first of all, on the broad point, I'm worried about it. I think within the capital markets, what's happening in the bond market is probably the most troubling issue we have. Just to put some math behind it, if you look at historical rates, we're running inflation between 2–2.5. So a money market fund should yield 2.5% today. Yields 1 basis point. If you go farther out the curve, treasuries should be, at 10 years and at 30 years should be yielding 150 to 200 basis points more than they are today. So this is a real artificial dampening of what's going on. So what we tell investors is to think about why you're in bonds. And I think 2 of the 3 reasons why people invest in bonds are still very legitimate. A lot of people invest in, just for the income. And, they don't need the principal, they just want the income thrown off by the bond fund. Actually, they should hope for a gently rising set of rates, because if that happens, they'll see their payments over time grow, and it'll be a good thing from an income perspective. If you're using bonds to dampen the volatility of an equity portfolio, so you've got a more balanced perspective, it's still not a bad thing to be invested in bond funds. If you're investing in bonds purely for a total return perspective, you got to do the arithmetic, and the next 10 years aren't going to look like the last 10 years.
I mean, people are buying in bonds because the bond market has been going up, so they say, well, that's great, I'm going to put my money in bonds. But we kind of know it's unlikely the next 10 years are going to look like the last 10.
If you look at the last 10 years, bonds have returned 5% a year, and with relatively low volatility versus equities. And so people have been attracted to that. Plus, there aren't any real options on the short-term side. So the next 10 years, if you just look at the yield to maturity, of a 10-year bond, it's about 2%. So that's your best predictor of future returns. So 2 a year versus 5 a year, huge difference.